Welcome! In this video, Zbcn coin 1000% bullish wave is coming and why. We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
Pulling Fibonacci from the bottom to the top is one of the most common methods used in technical analysis to understand the strength of a trend and potential retracement levels. In this method, the move from the bottom price level to the top price level is measured, and horizontal levels are drawn according to Fibonacci ratios. These levels can indicate potential support and resistance zones to traders. In the given scenario, the price has moved upward from the bottom to the top and then entered a retracement phase. At this point, the price reaching the 0.382 Fibonacci level shows that it has arrived at one of the first significant stops within the uptrend. The 0.382 level is often considered an area where, in strong trend scenarios, the price may resume its upward movement without much retracement. This level can act as a psychological and technical barrier where buyers have the potential to step in and push the price back up. If the price finds support here and buyer interest increases, the trend can continue to strengthen from where it left off, creating positive momentum in the market. However, if the price cannot hold at this level, meaning buyer interest is weak or selling pressure is intense, there is a higher chance that the retracement will deepen. In this case, attention shifts to the next strong support area, the 0.618 Fibonacci level. The 0.618 level, also known as the golden ratio, holds great importance in technical analysis. This point is often seen as a level where the price tends to reverse during corrections and where buyers can react strongly. From a market psychology perspective, the 0.618 level is both a frequently tested point in past price movements and a value thought to reflect the market's natural rhythm of fluctuations mathematically. For the price to find support at the 0.382 level, several conditions are generally expected. First, trading volume should increase at this level. This is because buyers becoming dominant in the support area strengthens the upward reaction of the price. In addition, candlestick formations that may form at this level can serve as signals for traders. For example, a strong green candle, long-tailed wicks, or engulfing patterns can increase the likelihood of a reversal from 0.382. On the other hand, if weak volume, small-bodied indecisive candles, or formations indicating selling pressure are observed, the risk of this level breaking increases. If a break occurs, selling could accelerate and cause the price to fall to the 0.618 level. A drop to the 0.618 level does not always mean a negative scenario. In fact, this level is often considered a natural part of a healthy correction. Especially in strong bull trends, the price pulling back to 0.618 and then turning upward with strong buying can lead to the trend regaining momentum and progressing on a more solid foundation. This type of retracement helps correct short-term overbought conditions in the market and allows traders to find new entry opportunities. In this context, a reversal from 0.382 indicates that the trend is maintaining its strength, while a reversal from 0.618 shows that the trend is building on a strong base. In both scenarios, the trend can continue. The important thing is to correctly interpret the signals the market gives during the reversal. Another factor to consider in such analyses is market psychology. Fibonacci levels are not only the result of a technical calculation, they also have a self-fulfilling effect because they are followed by many traders. When many traders place buy and sell orders at the same levels, those levels actually become influential on price movement. Therefore, the effectiveness of the 0.382 or 0.618 levels is not only mathematical, but also psychological. In conclusion, when Fibonacci is drawn from the bottom to the top, a retracement of the price to the 0.382 level is the first significant test point for the trend's strength. If strong buying interest appears here, the likelihood of the uptrend continuing is high. However, if the price cannot hold this level and selling pressure dominates, the decline may extend to the 0.618 level. This often represents a healthy correction and lays the groundwork for the trend to progress more firmly. For traders, the most important point is to evaluate the price action, volume, and other technical indicators together at these levels in order to take positions at the right time. But we cannot make a decision based solely on Fibonacci. Let's also look at other metrics. Stay tuned.
The RSI, or Relative Strength Index, is an oscillator frequently used in technical analysis to measure the momentum of price movements and to identify overbought or oversold zones. One of the most important features of the RSI is that trend lines can be drawn on it independently of the price chart itself. These trend lines can provide important clues about the direction of the market. In particular, a descending trend on the RSI indicates that market momentum has been under downward pressure for an extended period of time. This represents a period in which buyers are weak and sellers are dominant. However, when this descending trend is eventually broken, it signals a significant shift in market dynamics. This is because a trend break on the RSI shows that price momentum has changed direction, sellers are starting to lose control, and buyers are becoming more dominant. A descending trend break on the RSI often serves as a leading signal that a move may be starting on the price side as well. This is because the RSI can capture momentum changes before they appear in the price action. For example, even if the price has not yet shown a clear upward move, the RSI can break its descending trend and start to accelerate upward. This indicates that buyers are stepping in and that the price may soon react. Therefore, an RSI trend break helps identify potential upward moves in the price chart at an early stage. There are several key technical factors to watch for during the process of breaking a descending trend. First, the break should occur clearly. If the RSI line only briefly spikes above the descending trend line and quickly falls back, this could be a false breakout. For confirmation of a true breakout, the RSI should close above the trend line for several sessions or be accompanied by increasing volume at the time of the break. In addition, if the breakout occurs near the 50 level, considered the middle zone of the RSI, it shows that momentum is shifting strongly in favor of the buyers. The 50 level acts almost like a balance point for the RSI. Sustained movement above it generally supports upward trends. The impact of RSI trend breaks on price is often seen in rapid and strong moves. Especially when a long-standing descending trend is broken, the pent-up buying appetite can be triggered, causing the price to rise significantly in a short time. This often works like a chain reaction. First the RSI breaks, then the price starts to test resistance levels, and once these levels are breached, a stronger wave of buying emerges. From a market psychology perspective, breaking a descending RSI trend strengthens investors' belief that the downtrend is over and the uptrend is beginning. This expectation increases buy orders and can turn the rally into a self-sustaining process. The strength of the move after an RSI trend break often depends on the market conditions in which it occurs. If the breakout happens as the price is taking support from an important level, the sustainability of the move is stronger. Similarly, if a price pattern, such as an inverse head and shoulders or cup and handle, is forming and the RSI breaks its descending trend simultaneously with the pattern breakout, the combination of these two signals significantly increases the probability of an upward move. In such scenarios, both technically and psychologically, market participants' confidence grows, which strengthens buying pressure. However, there are also situations to be cautious about with RSI trend breaks. In low volatility, sideways markets, RSI breaks can produce misleading signals. In these types of markets, because price movements are weak, the anticipated rally after an RSI break may be delayed or may never occur. For this reason, investors should evaluate RSI breaks alongside price structures, volume, and other indicators. An RSI descending trend break also offers investors the chance to take positions in the early stages of trend reversals. This is particularly advantageous when it occurs at low price levels before the price has started to rise. Entering at these points offers a favorable risk-to-reward ratio, since buying at low levels provides high potential gains when the uptrend begins. In this sense, an RSI breakout is a valuable signal for both short-term traders and medium to long-term investors. Historically, it has been observed that many major upward moves were preceded by descending trend breaks on the RSI. This shows that momentum changes tend to precede price movements. Therefore, experienced investors closely follow such breaks on the RSI and adjust their positions accordingly. In conclusion, a descending trend on the RSI indicates that the market is under momentum pressure. But when this trend is broken, a significant change begins in market dynamics. Buyers strengthen, sellers lose influence, and this sets the stage for a move on the price side. Especially when the breakout is confirmed by strong volume, simultaneous support on the price chart, or the breakout of a price pattern, the likelihood of a stronger and more sustainable rally increases. For this reason, RSI descending trend breaks are among the high potential reversal signals that should be carefully monitored in technical analysis.
The ascending channel formation is one of the most important technical structures that shows price movements in the markets progressing in a certain pattern. This formation is created in the form of an upward sloping corridor between two parallel lines. The lower line of the channel represents the area where the price finds support, while the upper line represents the area acting as resistance. The middle band in between is often a dynamic zone that divides the price movement and can function as both support and resistance. Since the middle band is located exactly in the center of the channel, it is a highly critical level for investors. When the price is below this band, the uptrend is generally more cautious, whereas breaking above the band can significantly increase the momentum of the move. In such an ascending channel, the price breaking the middle band usually signals an important power shift in market dynamics. While below the middle band, price mostly experiences limited rises supported by the lower band. However, when the middle band is broken to the upside, this indicates that buyers have taken control of the market, selling pressure has weakened, and a more aggressive uptrend may begin. After this breakout, the price generally moves toward the upper band of the channel. The upper band of the ascending channel is a strong target area both technically and psychologically. Investors may consider taking profit when this target is reached, but in some scenarios, the price can surpass this level and continue much higher. The scenario of a potential 1,000% rise emerges after such extreme breakouts. Once the middle band is broken and the price moves toward the upper band, if market conditions are extraordinarily favorable, investor interest is intense, and buying pressure is strong, the price may not remain confined within the channel. Even when it reaches the upper band, buying can continue without losing momentum, triggering a parabolic uptrend that expands the channel upward. In parabolic rises, price increases progress exponentially. Extraordinary gains such as 1,000% occur during such processes. Especially in the cryptocurrency market, many assets in the past have experienced such massive increases in a short time after certain technical breakouts. The middle band breakout is not only a technical signal, it is also a clear reflection of market psychology. When this level is broken, many investors open positions with the perception that the trend has strengthened. This increases buy-side transactions and pushes the price further up. Positive expectations after a middle band breakout spread rapidly on social media, news sites, and investor groups. The fear of missing out, known as FOMO, kicks in, and this fear often becomes one of the strongest factors accelerating uptrends. In such periods, the pace of price appreciation exceeds normal, and large consecutive green candles form. In an ascending channel, the process of moving from the middle band to the upper band is usually not uninterrupted. Along the way, small corrections, short periods of sideways movement, or slight pullbacks can be seen. However, these pullbacks do not change the main trend direction. On the contrary, they are considered part of a healthy uptrend. Such pauses balance short-term overbought conditions in the market and create opportunities for new buyers to enter positions. Once the price reaches the upper band after breaking the middle band, if market enthusiasm is high, a rally that can go far beyond technical targets may begin. At this stage, the price increase multiplies from its starting point, and massive rates such as 1,000% become possible. For such a strong upside potential to materialize, certain conditions should be met at the time of the breakout. First, it is very important that the breakout is supported by a strong increase in volume. High volume shows that market participants take this move seriously and that there is real buying demand behind the breakout. Second, the overall market trend should also be upward. In other words, if not only a single asset but the general market sentiment is positive, such breakouts tend to be longer lasting. Third, fundamental factors should align with the technical structure. For example, important partnership news, a product launch, or a positive macroeconomic development can amplify the effect of such a technical breakout. After breaking the middle band, the price's movement toward the upper band is often a period when investors review their strategies. Risk management is vital during this process. While the price may have very high potential, it should not be forgotten that sudden corrections can occur. Experienced investors often take partial profits gradually during such moves, or raise their stop-loss levels step by step below the price. This method ensures both the protection of gains and the limitation of losses in case of a possible trend reversal. One of the strongest aspects of the ascending channel formation is that it provides investors with a clear roadmap. Since there are clear levels such as the lower band, middle band, and upper band, how the price will move between these bands follows a certain logic. After breaking the middle band, targeting the upper band is a very logical approach in technical analysis. However, for extraordinary increases such as the 1,000% mentioned in the scenario, the upper band must be exceeded, the channel must expand, or a completely new trend structure must emerge. Such situations generally occur during very strong bull markets and periods of high investor interest. In conclusion, the price breaking the middle band in an ascending channel is one of the clearest signs that the market is gaining strength and that buyers have taken control. After this breakout, a strong move toward the upper band is expected. If market conditions are extraordinarily favorable, this move may not stop at the upper band but can continue to much higher levels. At this stage, a parabolic uptrend begins, making massive gains such as 1,000% possible. Therefore, being able to identify middle band breakouts creates major opportunities for both short-term traders and long-term investors. Such a breakout produces the most effective results in periods when the technical structure is strong, volume provides support, and market psychology is fully buyer-oriented.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.